Alright, welcome back to the channel everyone. I'm Murph, and as always, I'm here with the brains of the operation, Cooper. Today, we're tackling a title that I know has already raised some eyebrows, the 1-minute Fibonacci scalping strategy that actually works. A lot of you are probably thinking, 1 minute? Come on, that's just noise. That's gambling. And you know what? I'm right there with you. Cooper, you have the floor. Convince me and convince them that this isn't just clickbait.
Chuckles softly. A healthy dose of skepticism is always the best place to start in trading, Murph. So thank you for that. And before we dive into a single chart or a single number, let's get the most important thing out of the way. Nothing we say here today constitutes financial advice. We are not financial advisors. This is purely for educational and informational purposes. Trading, especially scalping on a 1-minute time frame, carries an extremely high level of risk. You can lose your capital, and you probably will if you jump in without practice. Please do your own research and never risk more than you are willing to lose. Now, with that said, yes, Murph. It can work. But it requires a level of precision, discipline, and understanding that most people aren't willing to apply.
Okay, disclaimer done. Precision and discipline. I like the sound of that. It separates the pros from the hobbyists. So let's start at the beginning. Why the 1-minute chart? It feels like trying to read a book during an earthquake. It's chaotic.
It is chaotic. You're absolutely right. The 1-minute chart is filled with what we call noise. Random price wicks, false breakouts, it can be a minefield. But it also offers something invaluable for a scalper, opportunity. While a day trader on the 4-hour chart might be waiting all day for 1 or 2 setups, a 1-minute scalper might see 10, 20, or even more potential setups in a single session. The key isn't to trade all of them. The key is to have a rigid, rules-based system to filter the high-probability setups from the noise.
And that filter is the Fibonacci tool? I hear that word and I think of Renaissance art and spirals in nature. How does that connect to a currency pair like EUR/USD fluctuating second by second?
It's a fascinating connection, and it's all about market psychology and the rhythm of price movement. Markets don't move in straight lines. Even in a strong, obvious uptrend, the price will move up, then pull back, then move up again. Think of it like someone walking up a hill. They take a few steps forward, pause to catch their breath, and then continue. The Fibonacci retracement tool helps us measure those pauses, those pullbacks. It helps us anticipate where the price is likely to stop pulling back and resume its primary trend.
So it's not magic, it's just a mathematical way of measuring a market's tendency to breathe.
Exactly. We're not predicting the future. We are identifying a high probability zone where the balance between buyers and sellers might shift back in favor of the trend. The core Fibonacci levels we focus on are the 38, 2%, the 50%, and the 61. 8% retracements. In the context of this strategy, we're going to be laser focused on what many traders call the golden pocket, the area between the 50% and 61. 8% levels.
The golden pocket. Sounds like where you want to be. Okay, I'm hooked. Let's build this strategy from the ground up. I'm a trader. I've just opened my charts for the London session. I'm looking at GBP/JPY, which has been moving a lot lately. What is step 1?
Step 1, before you even think about Fibonacci, is to identify the immediate short-term trend. On the 1-minute chart, a trend can establish itself and be over in half an hour. So you have to be quick and objective. The simplest way is to look at the structure of the market. Are we making higher highs and higher lows? That's an uptrend. Or are we making lower lows and lower highs? That's a downtrend.
So, just visually reading the price action. Is there a tool that can help make this more black and white? Sometimes my eyes play tricks on me.
Absolutely. To add a layer of objectivity, I highly recommend putting an exponential moving average, or MA, on your chart. A 50 period or even a 100 period EMA can act as a dynamic guide. If the price is consistently staying above the EMA and the EMA itself is sloping upwards, you can confidently say you are in a short-term uptrend. If the price is below a downward sloping EMA, you're in a downtrend. For this strategy, that's rule number 1 in an uptrend. We only look for buying opportunities, we call them longs. In a downtrend, we only look for selling opportunities, or shorts. We always trade asterisk with asterisk the trend, never against it.
Okay, so step 1, identify the trend. Let's say the price is above the 50 EMA, it's making high highs. We're in an uptrend. We're only looking to buy. What's next? Do we just jump in?
No. This is where most new traders fail. They see the price moving up and they chase it, buying at the top right before it pulls back. This is called FOMO, fear of missing out. We do the opposite. We see the strong move up the impulse leg and we wait. We are patiently waiting for the pullback, the breath I mentioned earlier. Our entire strategy is based on getting into the trend at a discount.
Buying on sale. I can get behind that. So we see a big green candle and move up. Price creates a new swing high. Then it starts to drop a little. This is our moment.
This is our moment to prepare. The second we have a clear swing low and a clear swing high that formed the most recent impulse move, we can now use our tool. This is step 2, draw the Fibonacci retracement. For an uptrend, you select the Fibonacci tool, click on the starting point of the move of the swing low and drag your mouse up to the very top of the move of the swing high and release.
And for a downtrend, it's the opposite, right? We'd click the swing high and drag down to the swing low.
Precisely. The tool will then automatically overlay the key percentage levels on your chart 0. 0 at the top of the move, 100. 0 at the bottom and the retracement levels like 38. 250. 0 and 61. 8 in between. Now you have a map for the pullback.
Okay, the lines are on my chart. I see the price starting to fall from the swing high and it's approaching these levels. You mentioned the golden pocket. So we're just watching the price enter the zone between the 50 and 61. 8 lines.
We are watching it with intense focus. This is step 3, the entry zone. This 50% to 61. 8% zone is our area of high interest. Why? Because a pullback to this depth is significant enough to shake out weak hands and attract institutional orders, but not so deep that it invalidates the original trend. It's the equilibrium point. A 38. 2% pullback is often too shallow and the move can run out of steam. A pullback deeper than, say, 78. 6% starts to suggest the trend itself is failing. So we wait for the price to tap into our golden pocket.
But what if it just slices right through it? On a 1-minute chart, a bit of news or a big order can send the price plummeting. Do we just place a buy order at the 61? 8 line and hope for the best? That sounds risky.
And you are 100% right to say so. This is the most critical part of the entire strategy, the step that turns it from a coin flip into a calculated trade. Step 4, wait for confirmation. We never ever enter just because the price hits a line. A line on a chart is just a reference point. We need to see evidence that buyers are stepping back into the market and overpowering the sellers right in our zone.
And what does that evidence look like? What are we looking for on the 1-minute chart?
We are looking for specific candlestick patterns. A classic one is a hammer candle with a small body at the top and a long lower wick. This shows that sellers push the price down, but buyers storm back in and close the candle near its high. Another strong signal is a bullish engulfing pattern, where a green candle completely engulfs the body of the previous red candle. It's a very visual representation of the shift in power. You can also look for a simple break of a micro trend line. As the price is pulling back, you can draw a small trend line over the highs of the pullback. When the price breaks and closes above that tiny trend line asterisk after asterisk having tested our golden pocket, that can be your entry signal.
So to recap so far, 1. Identify the main trend using price structure and then EMA. 2. Wait for an impulse move and a subsequent pullback. 3. Draw the Fibonacci from the swing low to swing high of that impulse. 4. Wait for the price to enter the 50-minute 61. 8. Golden pocket. And 5. Wait for a confirmation candlestick pattern or a micro trend line break asterisk with an asterisk that's own before you even think about clicking the buy button.
Perfect. That's the entry criteria. It's a 5-step filter. If any one of those conditions isn't met, there is no trade. You simply wait for the next opportunity. Discipline is everything.
Okay, we got the signal. A beautiful hammer candle formed right on the 61. 8% level. We're excited. We enter the trade. We're in. Now what? This is where I think a lot of people panic. They don't know where to get out for a win or a loss.
And an entry without a predefined exit plan is just gambling. So, before we enter, we must know 2 things: where our stop loss will be and where our take profit will be. This is step 5, set your stop loss. The rule is simple and logical. Our entire trade idea is based on the premise that the impulse move starting point, the swing low, will hold. If the price breaks below that low, our trade idea is wrong. Therefore, the stop loss must be placed just a few pips below that swing low from which we started drawing our Fibonacci tool.
That makes sense. If it goes past the starting point of the run-up is officially cancelled. The trend is likely reversing.
Exactly. It provides a clear, objective invalidation point for the trade. This protects you from a catastrophic loss if you're wrong. And your asterisk will asterisk be wrong sometimes. Accepting that is part of being a trader.
Alright, stop loss is set. We've managed our risk. Now for the fun part. Where do we take our profit? How do we know when to cash in our chips?
Step 6, set your take profit. There are a few ways to do this, ranging from conservative to aggressive. The most conservative and highest probability target is the previous swing high, which is the 0. 0% level on your Fibonacci tool. The logic is that the price is likely to at least retest its previous peak. For a scalper, that might be all you need, a quick 8, 10, 15 pips.
So, buy in the golden pocket, sell at the last peak. A nice contained trade. What if we think the trend is really strong and has more room to run? With all the talk about inflation easing slightly, maybe the market has legs.
A great question. For a more aggressive target, you can use Fibonacci extension levels. When you draw your tool, many platforms allow you to show extension levels like -27, 2% and -61, 8%. These are projected profit targets asterisk beyond asterisk the previous high. A common secondary target is that -27, 2% extension. So you might close half your position at the swing high and let the other half run to the extension level, moving your stop loss to break even to ensure risk-free trade.
I like that. Scaling out. It lets you lock in some profit while still participating in a bigger move. What about using a fixed risk to reward ratio? I hear people talk about that all the time.
That's the third method, and it's excellent for maintaining discipline. Before you enter, you calculate the distance from your entry to your stop loss. Let's say it's 10 pips. You can then set your take profit at a multiple of that risk. A 1. 5 to -1 risk/reward ratio would mean setting your take profit 15 pips above your entry. A 2 to -1 would be 20 pips. Sticking to a minimum risk/reward ratio, like 1. 5 to -1 ensures that your winning trades are significantly bigger than your losing trades, meaning you don't even need to be right 50% of the time to be profitable.
Okay, this is a lot more systematic than I thought. It's not just looking a squiggly line and guessing. Let's do a rapid fire example for a short trade, just to solidify it. Let's say we're looking at Bitcoin, which has been incredibly volatile.
Great example. The principles are universal. So, for Bitcoin on the 1-minute chart.
1. Asterisk trend, asterisk price is trading below downward sloping 50 EMA. It's making lower lows and lower highs. The trend is down. We are only looking to sell.
2. Asterisk impulse we see a strong move down, creating a new swing low.
YE. Asterisk pullback and fib asterisk price starts to rally to pull back up. We grab our Fibonacci tool, click the swing high where the move started, and drag down to the new swing low.
4. Asterisk golden pocket asterisk we watch as the price rallies up into the 50% to 61. 8% retracement zone.
5. Asterisk confirmation asterisk inside that zone, we see a shooting star candle or a bearish engulfing pattern. This is our signal that sellers are regaining control. We enter a short trade.
6. Asterisk stop loss asterisk we place our stop loss just a few ticks above the swing high where we started drawing the tool.
7. Asterisk take profit asterisk we place our primary take profit target at the recent swing low at the 0% fib level or use a 1. 5-1 risk/reward ratio. Crystal clear. It's a mirror image of a long setup. Now, let's talk about the elephant in the room, the psychology. All these rules are great on paper. But when you're in a live market with real money on the line and the P&L is flashing red and green, how do you not just completely lose your mind?
You've hit on the single biggest reason traders fail, Murph. It's not the strategy, it's the trader. The 1-minute chart is a psychological pressure cooker. The speed is immense. You might have a winning trade and a losing trade within 5 minutes. The key is emotional detachment. You have to view each trade as just one instance in 1,000. It's a data point. Did you follow your rules? Yes? Then it was a good trade, regardless of the outcome. Did you break your rules? Yes? It was a bad trade, even if you got lucky and it won.
So, no revenge trading after a loss? Trying to win it back immediately?
Revenge trading is akin to suicide. If you take a loss, and you will, you must accept it calmly, see if you followed your plan, and then wait for the asterisk next to asterisk valid setup according to your rules. If you feel angry or frustrated, the single best thing you can do is step away from the computer. Go for a walk. Get a coffee. The market will be there when you get back. Your capital won't be if you let emotion take the wheel.
What about market conditions? Does this strategy work all the time, 24/7? Or are there times when we should just sit on our hands?
An absolutely critical point. This is a trend-following strategy. Therefore, it works best in trending markets. The worst possible time to use this strategy is during a choppy, sideways, range-bound market.
And how can we identify that? What does a choppy market look like with our tools?
The EMA we use for the trend is a great guide. If you see the price whipping back and forth across a flat, non-sloping EMA, that's a clear sign of consolidation or chop. The market has no direction. In those conditions, a Fibonacci pullback strategy is useless because there is no trend to pull back asterisk from asterisk. It's like trying to surf when there are no waves. You're just going to get tossed around. The best times are often during the high-volume sessions, like the London Open or the London-New York overlap, when major pairs tend to trend more clearly.
So, part of the skill is not just executing the strategy, but recognizing the environment in which the strategy is likely to succeed.
That is the mark of a professional trader. They know when to trade and, just as importantly, when not to. Your first job as a trader is not to make money, it's to protect the capital you have. Sitting out of the choppy market is you doing your job.
Let's talk about the assets themselves. We mentioned Forex crypto. Does this work on something like the Nasdaq 100 index or individual stocks?
The principles of trend, pullback, and human psychology are universal. So yes, you can apply this to indices like the NQ or the S&P 500, and even to high-volume stocks like Tesla or Apple. However, you must be aware of the instrument's personality. Indices can be extremely fast and respect technical levels very cleanly. A stock might be subject to news about that specific company. Cryptocurrencies have a much higher volatility, so you might need to adjust your position size to be much smaller to account for the wider swings. The strategy is the framework, you have to slightly adapt its parameters for the playground you're in.
And what about journaling? I hear you talk about this all the time off air. How important is it for a strategy like this?
For a high-frequency strategy like 1-minute scalping, a journal is not just important, it is non-negotiable. After every single trade, win or lose, you should take a screenshot of your chart. Mark your entry, your stop loss, and your take profit. Write a small note. Why did you take the trade? Did you follow all 5 entry rules? What was the outcome? At the end of the week, you review your journal. You might discover that most of your losses come from breaking your confirmation rule. Or maybe your trades against the 100 EMA work out better than your trades against the 50 EMA. The journal is your data. It's how you optimize your performance and plug the leaks in your execution. Without it, you're just repeating the same mistakes over and over.
So you become your own trading coach, using your own data. That's powerful. Cooper, this has been incredibly detailed. We've gone from a clickbait title to a comprehensive, rules-based business plan for a scalper. Any final thoughts? What is the one thing someone listening to this should take away and do first, before risking a single dollar?
100% demo trading. Open a demo account which uses fake money and apply these rules. Do it for at least a month. Take at least 100 trades. Don't just look to see if you made fake money. Look at your journal. Were you disciplined? Did you follow the rules on all 100 trades? Can you handle the psychological stress of seeing 10 setups in an hour and only taking the 2 that meet your strict criteria? Test the strategy, but more importantly, test yourself. This strategy works if the trader executing it is as robotic and disciplined as the rules themselves. If you can prove to yourself you can do that in a demo environment, then, and only then, should you consider trying it with a very small amount of real capital.
Fantastic advice. So there you have it, folks. The 1-minute Fibonacci scalping strategy. It's not a magic bullet. It's a sharp, precise tool that requires skill, patience, and an iron will. But as Cooper laid out, it is a complete system with clear rules for entry, exit, and risk management. The actually works part of the title isn't about the lines on the chart, it's about the discipline in your head. Thank you so much for breaking that down, Cooper.
My pleasure, Murph. Stay safe out there, everyone. And trade smart.
That's all for us this week. Don't forget to like and subscribe if you found this valuable, and let us know in the comments if you've ever tried using Fibonacci for your scalping. Until next time.